Global growth is holding up, but just barely. Currently, the IMF projects the world economy will expand by around 3% this year, with only a slight pickup in 2026. Beneath those numbers lies an important question. Is this resilience sustainable, or are we still one shock away from renewed volatility? To unpack the drivers of this modest recovery, from technology and regional momentum to tariffs, inflation, and geopolitical tensions, I'm joined today by Vincent Deluard, StoneX Director of Global Market Strategy. Vincent, thank you for being with us.
Always a pleasure.
First of all, Vincent, how would you characterize the IMF's current growth outlook of around 3% for 2025?
Yeah, I think what's important to understand here is that this has more to do with the IMF than it has to do with growth itself. So when the IMF does this quarterly growth forecast part of the economic outlook, and the last one was made just amidst the kind of April Q1 growth panic. We had the Rose Garden announcement. And the IMF, in my opinion, made an ideological mistake. The IMF is generally committed to multilateralism. I mean, that's kind of the purpose for their being. They committed to free trade. So now suddenly you have a president that puts that into question in the U.S. And I think they wanted to make a statement. Tariffs are bad. Things are going to be awful. So they took down their growth estimate. While in reality, it was clear from the start that it wouldn't be all that much. I mean, we're talking about, tariffs are probably going to raise anywhere between $300 to $400 billion. So we're talking about a $300 billion tax on $100 trillion world GDP. So it's 0.001% or something like that. So I was always very skeptical that such a small change in policy would have such a big impact on, you can think of, global economic growth as a Titanic. It has enormous momentum, enormous inertia. So what's going on in the IMF is slowly fixing its mistake rather than anything fundamentally changing in the nature of the world economy.
And the recent modest recovery we've seen, what are the key drivers underpinning this, do you think?
So again, I would not characterize this as recovery because I don't think it ever slowed in the first place. It was just the IMF kind of throwing a tantrum there. But what supports growth in general is human ingenuity. I mean, at the end of the day, we are a smart species of monkey, and we figure things out. So then the default for the global economy is to grow by about 3%, because in developed economies you had about 2% productivity growth, a bit faster in emerging economies. So unless you have like a major war, which hopefully we still haven't yet, we have localized conflict and major disruptions to the world economy, you would expect to see this kind of 3% growth. And I would argue that this year we get a little bit more because we have extremely stimulative policy all around the world.
And there are downside risks as well. What do you see as the most immediate threats that you're watching?
Well, I would, again, going back to this idea that the natural state for economies is to grow, unless you do something very stupid to slow that process. I would say the biggest risk is that we do something very stupid. So you can think about geopolitics. I think it's probably the biggest one. We hopefully we'll see. I mean, it looks like we're getting peace. Eventually, we're going to get peace between Russia and Ukraine. The China-U.S. tensions are probably the biggest risk to growth if we see this re-escalate. The pause on the China tariff is set to expire in about a month. So if we go back to this kind of escalating tariff, but again, I don't think that's the path that the global economy is taking right now.
Okay. And as far as sort of public debt is concerned, are there any, do you see that as a risk at all?
Yeah, in certain countries, yes, you certainly see some of that in Europe, France, Japan. You see these rising bond yields all around the world. But again, I would say it at the end of the day, it's a political decision. I mean, you can always sovereign, like the fact that this debt crisis is happening in what we call monetary sovereigns makes me less worried. If you have a debt crisis in a country that borrowed a lot in a foreign currency they cannot print, or in gold or whatever, then you know that there's going to be a problem, because at some point people are going to ask for their money back, and there's going to be government cuts, and that's going to impact growth. Now, if you are Japan, and about half of the debt that you issued is owned by your central bank, or by domestic savers, it's more of a matter of reshuffling the composition of these assets and liability, which of course involves some political trade-offs. So I'm not saying it's easy. Certainly we see in France that it's not easy. But at the end of the day, there is no hard constraint on growth. You decide, effectively governments decide whether they want to deal with the crisis with kind of a recessionary mix of fiscal consolidation or a more inflationary mix of money printing. My idea is that most countries are choosing this kind of inflationary mix, as we see in Europe with, for example, the 3% deficit target, which even Germany, which was the biggest enforcer, is now breaking.
And beyond these immediate risks, are there sort of longer term structural challenges that investors should be aware of?
I mean, in general, in advancing, but even developing economy, really the biggest one is demography, right? And we had this, global slowdown in birth rates. It's been going on for 40, 50 years in Japan, a little less in Europe, and now you see even major emerging economies like India, Turkey, Iran, where the birth rate, the fecundity rate has fallen below 2. So we have aging populations. As population age, you naturally reduce the rate of growth, because you have fewer workers entering the labor force, more them and more seniors and retiree living off the work of other people through usually a government transfer, or if it's privately owned, through the private sector. So that's the biggest challenge. Now, it's not an insurmountable one. I think we have the rapid advances in AI and robotics come as natural solution to this issue, but it does mean that certainly there will be a greater transfer, and that's that. Again, I find it more um, enlightening to think of a lot of these issues as generational transfers than it is about the size of the pie. I mean, you can have a pie that expands very rapidly if only a very tiny sliver gets the benefit of that growth, which unfortunately has been the story for much of the past 20 years. It doesn't do anything, right? So what's happening now is we have to sit around the table and think about how we share that economic pie. And unfortunately, we know that a greater share of that pie will have to be allocated to social expenses.
And taking this balance of growth drivers and risk, what scenarios should investors realistically prepare for over the next sort of 12 to 18 months?
I mean, short term, I'd remain fairly bullish on global growth. Again, let's go back to policy. So we have stimulus in the US. The fiscal impulse is positive, even though the economy is at full employment. We're running a deficit of 7% of GDP. I mean, this is somewhat unprecedented. In Europe, we have the German stimulus, which is a huge game changer, right? Going from fiscal consolidation to 3-4% deficit in the European largest economy. China. So China, we have a little bit of a soft patch because we had some stimulus earlier this year. I suspect we'll get more, but for now, yeah, we see maybe. But again, we're talking that the 5% growth target is still fairly elevated. Maybe they miss it by a couple of basis points, but that's not a huge deal. And then if we look at monetary policy, it's very accommodative. Out of the 53 major central banks, 49 had a cut the last move. So you have global monetary easing. M2, which is the money supply, is growing by more than 5% in Europe, in the US, in Japan, and in China. So for the first time, at least since I can remember, we have coordinated monetary easing. And then finally, we have a weak dollar, and a weak dollar is extremely stimulating for the rest of the world. I mean, the dollar had its worst so far this year, worst start of the year since 1973. Now, most of the world, or a lot of the world at least, has dollar debts. So when the dollar falls by 15%, everybody's 15% richer. So that opens up possibility for policymakers to do other things and just worry about the value of their exchange rates. So, yeah, I think the trade remains long nominal growth, long inflation, and we'll worry about recessions another year.
Well, thank you very much for your insights once again, Vincent.
A pleasure. Thanks for having me.
Thank you. For more videos like this, please do like and subscribe.